Hey everyone. We've kind of gathered in a small group to discuss some of the more in-depth projects we have going on CPE these days, and how we're kind of looking forward to the year 2026. These include a bunch of pieces that have an outlook, and that's what our series is called anyway, towards the following year, but also some of the more detailed items that we looked at concerning subsectors of the industry. So with my colleagues here, we've kind of organized this little chat to go through everything that we have going on. I'm not sure, but if there's anyone that wants to kind of kick us off and talk about one of these more in-depth outlooks and pieces, that'd be pretty cool. That'd be a really good starting point.
Yeah, I can do that.
Awesome.
I can do that because I already finished working on my outlook, which is the 2026 Green Building Outlook. So here's what I learned and what matters for owners, lenders, and investors right now. Basically, if 2025 was guidance, 2026 is about delivery. Cities like New York spent last year helping owners get organized rather than leading with fines. That bought time. So this year, the message is choose a pathway, file, and execute. Execution is simpler than it sounds. You should start with a tune-up, fix schedules and sensors, stop heating and cooling at the same time, and get your control sequences working the way they should. Then tighten the shell, air sealing, better windows, insulation. Do those first, and the building holds temperature as designed. Only then swap the equipment. At that point, you can right size to a smaller, efficient heat pump, which cuts upfront costs, replacement cost, and refrigerant risk. In short, physics that improves the pro forma. On materials, the fastest win is concrete. Low carbon mixes are widely available and often at or near cost parity with standard mixes. The key is to ask for facility-specific environmental product declarations, which is basically evidence from the actual plant producing your mix. So you're comparing apples to apples. Buyer alliances are also making it easier to set low carbon specs without blowing up the bid. Now, capital, because none of this moves forward without funding. Long tenor, fixed rate clean energy financing has moved to the middle of the stack. Typical 2025-2026 pricing has stabilized around 5.5 to 8.5%, with many deals closing in about 45 to 60 days, a bit longer in New York. Underwriting is policy aware. If your scope clearly avoids a city penalty, lenders remove it from the model. If not, they price it in. We're also seeing consistent stack patterns. For new construction, a senior loan covers 65 to 70% of cost. Clean energy capital is at 25 to 30% plus equity and incentives. While for retrofits, a senior loan is at 60 to 70%, clean energy capital at 25 to 25%, plus tax credits and rebates. A quick note on rate reductions tied to performance. PACE Equity's Cyrus program lowers the CPACE rate if a project meets a clear low carbon spec. It recognizes LEED and the partner network of established rating systems, such as Green Globes, Passive House. Three takeaways would be the rate break often outweighs the upgrade cost. Fees can be rolled into the financing. And if you refinance within 3 years of opening on a certified building, you can still lock the reduced rate. They also provide engineering support to help teams hit the spec. That shifts total cost over time, not just the stack on day one. If I was to give a 5-step plan for 2026, this would be it. 1, pick your pathway with the city. Book their office hours because they shorten your learning curve. 2, tighten operations now. Get the tune-up done for quick, low-cost savings. 3, envelope first, then equipment. Seal, windows, insulation, then right size and electrify. 4, align the stack early. Settle lender order, map the draw schedule, and use green rate options like Cyrus when the spec pencils. And 5, keep receipts. Organize energy, water, carbon, and material evidence so regulators, lenders, and buyers all see the same clean story. Bottom line, 2026 is when rules meet reality. Thank you.
Okay, I have a bunch of follow-ups here because it feels like you're delivering a message from the industry that there's, or at least I feel that there's a lot more urgency to this process. So the 5 things you mentioned as kind of advice for people building green relate to some level of immediacy and keeping all of the operation tight. Do you see that as a through line?
Yes.
And has that become more urgent this year and in 2026 than in other years?
Well, the thing is, look at New York City. They have the local law 97 for 8 years now. The local government issued so many emails and phone calls and organized more than 60 info sessions to teach building owners about the process. Now, 2026 is the year when if you did not meet the requirements, you will pay fines. And those fines are hefty. I mean, it's gonna be painful for those who don't do it. But about 94% of the buildings in New York are already compliant in some way with local law 97. So basically, we're talking about another 1,500 buildings that still need to ramp up their work towards lower carbon emissions. So yeah, there is definitely urgency in the outlook for 2026 for green.
Yeah, it feels like a last chance saloon for some of these buildings.
Yeah.
And since it's New York, that's like quite a volume of buildings. Mentioning 5%, but that comes out to like 14 or 1,500 buildings you mentioned. So yeah,
15, yeah, 15.
Yeah, so
Yep.
that's a lot. Okay, and I can tell that the sustainability outlook is done because this was like a very thorough run through that piece. So yeah, I guess we'll link to all of these materials that are already published in our description. So for everyone watching this and trying to get a sense of the particulars that we're discussing, kind of check out all of the materials included below. So yeah, on sustainability, I feel like there might be a through line here because there's a sector or a subsector that pretty heavily intertwines with sustainability. And Tudor, I think you had something on that.
Oh yeah. I can speak about what I'm working on next. And while Anca was was talking about sustainability, what I was thinking about is basically 2026 being a year for efficiency in operations, in building, in development, and so on. And this ties into the data center sector, which we all know, or we might have seen, even from our reporting and other places, that it's been quite a few peak years for the sector, so to speak. Both 2025 and the prior 2 years or so have resulted in a massive shift for the sector, and most of it is pushed by AI, of course, as we all know, but it has been underlying there for quite a while, and that shift is that basically when thinking about data centers, it's all about the power, right? Land is no longer the most important factor at play as it is in many other real estate sectors, but rather access to power and access to basically clean energy is the number one factor at play here, especially when we're talking about these enormously sized facilities that are being built today. I was just talking with someone from EdgeCore Digital Infrastructure, who is one of the companies at the forefront of this new wave of data center development. And they were talking about how a few years ago, like 5 years or so ago, you could never think of you could think of this, but it wouldn't be so easy to imagine a 1 gigawatt data center. Whereas today we're seeing them already being developed. So this basically means, to bring it back to what I was talking about earlier, this basically means that efficiency is key, right? And this is what I'm hearing from the people in the industry. I actually want to bring up my new podcast series, which is called Alternative Disruptors. It's on
Yeah,
CPE.
plug.
In the first episode, I talked with Alex Tower, who is the co-founder and CEO of Greenlight Data Centers, and their model is a bit different from what's been going on in the industry, which is that they target mid-size facilities. They develop them and bring them online in areas that are not so power constrained, right? Because we've seen in these past few years that there's been a lot of spillover into secondary, tertiary markets where these sort of rural areas or out of big cities that have plenty access to power. And so basically, there's a few factors at play here. On the one hand, you have these huge facilities that are coming online from the likes of Google, Amazon, Meta, and so on. But you also have companies like Greenlight or others that are going for like speed to market as opposed to just scale. Because bringing even a 50 megawatt data center, when thinking about developing something like that, you're getting close to a 1 billion price tag, right? Which is quite crazy to think about. And efficiency is the key, right? To bring it back to what I was talking about earlier.
I feel like with data centers, or at least the model that you discussed with Greenlight, there's this sense of urgency that Anca mentioned about green building. So, can you outline some of the, like, I'd say, like, core characteristics that companies like this are looking for when trying to get a project like this off the ground?
Yeah, definitely. And it's not just companies like Greenlight, for example, that I only gave that example because I have a podcast episode with their CEO, but this is common ground for basically any type of facility you're trying to bring online today. And yeah, there is a sense of urgency because there is a competition for access to power. As I said, basically the grid, the U.S. electrical grid, needs to be updated. This is a piece of infrastructure. I mean, not a piece. It's a very complex network that needs a lot of efficiency upgrades in a lot of ways, and both from transmission to generation of power. So this is why there's a huge competition for access to power, and basically that is what brings the sense of urgency in this sector. It's that I mean, on the one hand, because on the other hand, you have the race for AI, right? And you also have the race to build inference and training facilities for AI. And another factor is access to chips, which is also a limited resource. Like, yes, production of chips has grown worldwide, but you're still dependent on how fast you can pump those out. So there's that, and basically less limiting factors would be access to land and networking, which are usually not that big of a deal as I mean, they are very important, they are critical, but it's not such a scarce resource as
It's not the most
electricity.
pressing one.
Exactly, yeah. So the most concerning one would be access to power, and so that also creates this need for efficiency in all matters, in all aspects, from how you build your facility to how you design it, to what types of cooling you're using. And one of my guests on the podcast, he thinks that liquid cooling will become a baseline from now on, which is direct to chip cooling, because simply because the density of power per rack in a data center has grown like at least 10 times with AI. We're talking AI facilities now. So there is this huge push for I mean, you need to be efficient because the cost of everything is simply enormous. We've all seen the headlines and how big the numbers are, so to speak, when it comes to how much money is flowing around the sector. Yeah.
So that is why a lot of data center providers invest in building their own solar farms and wind parks, right?
Yes.
It's been a growing number in recent years. And
yeah,
I remember reading about this. I don't know. It was a northern European country that they will start using the data centers heat to heat up cities. And I thought that is so amazing. It's like, you have it, you're up north, it's really cold. So you can actually, so it's a really cool sector. Yeah.
Kind of shows you how high-flying data centers are right now. With the conversations of bubbles and stuff. That's definitely one of the flashier subsectors in commercial real estate right now.
Yeah.
Yeah, it's great to hear that some sectors are performing well. Because the office one continues to do so and so. But yeah, this is nothing new, I guess. Starting with the pandemic, things have been going pretty downhill. But hey, there's a light at the end of the tunnel for the office sector this time.
Oh, great to hear.
Yeah, I've been pretty surprised because before I received the answers and I started working on the office outlook, I was a bit nervous, Is it gonna be disheartening like the last one?
Yep.
Is there a like fake positivity in the air? But yeah, I think for the first time in a couple of years, things are starting to look up. And that's because, like in therapy, the key word is acceptance. And basically, owners, lenders, tenants are accepting the new normal and normal work, the new work patterns. There isn't anything to bargain about. Things are as they are, and accepting this new normal will finally allow the market to move forward and to evolve, basically, because the office sector has been in a pretty stale puddle, if I could say so. And hybrid has become the standard. It's been a pretty long transition, which is finally well shaped right now. Most companies are moving away from the come in if you want mindset to structured anchor days and collaboration focused layouts. Flexible design and biophilic design has been pretty much trending for 2 years or so. Traditional desk frames are giving way to flex zones, hot desks, and work points. And the office has become from a place to shift to a place where people gather to actually collaborate and create a proper community. And we're also seeing a sharp flight to quality. This has also been going on for a couple of years now, but prime assets in core markets continue to have steady leasing, while older, inefficient buildings are struggling, and of course, the development pipeline dropping to a historic low doesn't help either.
Yeah.
And we've also had a major capital market shift in 2025. Lenders and institutional investors are coming back, but only for the right product. So yeah, money is never for free, but especially now. So yeah, to sum it up with 2025, because it really paves the way for 2026, we're starting to see winner's circle, something we haven't really been seeing in a while. And that's the difference between tier 1 and tier 3 and 4 assets, office assets. Meaning tier 1 assets post 2015, highly amenitized and so on, continues to fare great, while the ones from the 90s, vintage 90s, I can't believe I'm saying that, but
That's weird to hear every time.
yes, I'm vintage too. But yeah, so pre-90s office assets have to either be converted, and usually that goes to residential, or they're being scraped, effectively scraped off, raised off, and the land is being redeveloped. And worst case scenario, worst case, if there's nothing that can be done, loans are sold or short sales are being made. So office isn't dying, obsolete office is. That's one of the main ideas. And as I already mentioned, 2026 will continue this legacy of change. It will not be a groundbreaking year, but the demand will be focused on smaller, smarter, and more flexible layouts. Office utilization will jump to pre-pandemic levels only in 2030. And we still have a couple of years to go. For 2026, the outlook is not great, not terrible. Office utilization is expected to jump to 55-65%. And that doesn't mean the office is disappearing, but rather that large monolithic headquarters are vanishing, are shrinking, and portfolios are becoming more diverse. So diversifying your portfolio for investors is going to become a key shift for 2026. That if they want to survive, of course. Seeing this downsize in footprints, this will also lead to a rapid growth in flex and co-working spaces as a strategic tool, not only for startups as a startup solution. And co-working is expected to grow from 2.2% to 8 or 10% in the coming years, which is a lot. As owners brand or partner to fill vacant space. And an emerging trend would be the hub and spoke and suburban satellites to get closer to talent and shorten commutes because flexibility is key. Basically, demand will continue to be concentrated in high-quality, transit-rich, amenitized buildings, while older assets will sustain pressure or conversion going forward. And 2026 could be the year where investors shift from office curious to office serious as liquidity improves, which is very important. Liquidity is needed for anything you'd like to do. So yeah. As I already mentioned, the under construction pipeline is not faring great. Much of the active pipeline is already pre-leased or it consists of built-to-suit assets. So that will signal an intense competition for the very best space and rental spikes in some markets where tier 1 vacancy is already under 10%. So yeah, 2026 is going to be a year of gradual normalization, not a dramatic rebound, but steady progress towards a more balanced market.
So you mentioned acceptance as a big word for the office sector going on and looking forward. But from what you mentioned, another A word comes to mind, and that feels like appreciation should be pretty heavily tied to what's going on, like relying on what you have as quality assets, repurposing to focus on stuff like biophilic design. And from what everyone in this call mentioned until now, a focus on what you put in any type of asset you have, whether that's making it more efficient, having a tight capital stack. That these are all things that you do in your process to work with your asset to make sure that it has a greater chance at success, whether it's in a high performing subsector like the AI-driven data center boom, or in what is an ongoing rebound or I don't know, repurposing of how the office sector sees itself. And I feel like we mentioned, although not as one of the core elements of this, but it feels like we keep bringing up stuff like design. So I'm gonna shift this over to Bea for a second. So, maybe we can talk about stuff like beautiful designs and prettier things to get us wrapped up.
Yeah, and design trends and architecture trends in the last year. So it was interesting to listen to all of you because what I have found in my stories was also reflected in your summaries, like AI and tech integrated into architecture, biophilic design. Of course, conversions was really big in 2025, and I think it's still gonna be an ongoing trend in the year to come. Yeah, so everything I've heard from you, I have seen in my work. I cover usually architecture and design stories behind the project. Mixed use is really becoming what mixed use should actually be, like a live, work, play combination of functions coming together. Not only have mixed use is not an apartment community with the street level retail anymore. Mixed use is like offices, co-working spaces, living rentals, condos, all coming together, and developers are engaging in this more holistic approach to projects, and architects are doing the same. So they are thinking more holistically. And in the past year, I have worked on several projects like this. One is in downtown Atlanta. It's a revitalization project, which entails like 57 historic buildings, which mostly have been underused or just forgotten about. The whole area was not working as it should. And we have seen this trend in a lot of downtown areas where people are not coming in, nothing is happening. So investors are really coming in with capital and trying to revitalize these into spaces where people actually have things to do. They want to come here. And this is what is happening in Atlanta, in downtown Atlanta. Ahead of the 2026 FIFA World Cup, the city is ramping up on everything it can to make it more magnetic to people. And so this project has been really interesting. They are creating a mix of residential spaces, also affordable housing integrated, street level retail, restaurants. So it's really an effervescent attitude and atmosphere coming to South Downtown Atlanta. So if you want to read more about this project, you can. And another one that I'm currently working on is also a mixed-use revitalization project in Hoboken, which is right across the Hudson River from Manhattan. So for this project, Hoboken Connect, the most important aspect maybe is the great location of the project, because it's so close to Manhattan. But unfortunately, the ferry terminal and the multimodal hub has been functioning mostly just a traveling through area. People are not stopping, they are just commuting because it's so close to their workspace. And the developer, Alcor, in a collaboration with New Jersey Transit and the city of Hoboken, are trying to breathe new life into this area, to bring in also ground up new developments, 2 new buildings, a residential one and an office one, and also renovating the historic Beaux-Arts Lackawanna terminal, which it's a historical heritage. It's really something that can draw people's attention because it's so beautiful. It has been built in the beginning of the 20th century. It also has a 230-foot clock tower. And so the historical architecture is really beautiful. They are gonna try and bring in some new uses to the terminal, like contemporary event space and exhibition venues. And so this is a really nice mix of renovation and contemporary coming together, public, private coming together, and really trying to make a change in Hoboken. So I think this is going to be really interesting. I'm talking to one of the developers, Alcor. They have I think 50 years of experience in mixed use development. So they are a great source for this, and they really know what they're doing. also a lot of infrastructure changes, trying to bring in more pedestrian and cyclists, and yeah, check it out. You're gonna see a lot of interesting renderings and pictures of how Hoboken Connect is gonna look like.
That's really cool. It feels like they're trying to take advantage of a lot of traffic to kind of, but
Yeah.
kind of keep people around for a
Exactly.
while.
Yes, because they didn't really have much to do there before, but
Mhm.
after this, yeah, they're gonna open it up for the public.
Okay. So mixed use and
Mixed use,
redeveloping,
definitely. Yes.
yeah, can kind of bring people together a lot more and kind of bring more meaning and maybe purpose to these large scale developments that have been popping up for quite a while, but maybe there wasn't necessarily a clear recipe to how to make it all work for the city apart from the actual transit function. So that'll be cool to follow if it works out. Yeah, I guess thanks everyone for outlining all of your great work for CPE. Again, as mentioned, all the links to what is already published will be included in the video description. And for everything that's forward-looking, we're I guess just gonna heavily tease it in that video description to follow our coverage for all of these pieces. Thank you all for having this cool conversation and talking about what you have going on. And we'll see you on the next one. Thanks.
Thank you.
Thank
Thank
you.
you.
Thanks.
Bye.
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 Bye.